Welcome to our webinar on investing internationally for the global Filipino in Singapore and beyond. Brought to you by LINC Wealth Advisers, a branch of Synergy Financial Advisors. You can find out more about LINC at linkwealthadvisors.com. I'm delighted to be joined for today's event by Rainer Akbari and Joanne Ong. Originally from San Francisco, California, Rainer lived in Germany for 13 years before moving to Singapore in 2005. After a career in corporate banking, he moved into private wealth and risk management and launched LINC Wealth Advisers in 2020. Originally from the Philippines and based in Singapore, Joanne is an investment and financial advisor and relationship manager at LINC Wealth Advisers. Previously, she worked at Prudential. Before we start, please bear in mind that the information presented is for general educational purposes only and should always seek your own personalized financial advice. After the presentation, Rainer and Joanne will be answering your questions, so please add them in the chat function at the foot of your screen, as and when you think of them, and we'll try to answer them all at the end, time permitting. Note that you can access our panelists' contact details using the VR code in their Zoom backgrounds, or please get in touch at linkwealthadvisors.com. So, without further ado, I'd like to hand over to Joanne.
Good afternoon, everyone. Thanks for joining us this afternoon, and thank you for gracing us this afternoon in our investment for global Filipinos. Okay, so we are from LINC Wealth Advisor. Rainer is actually my manager, my director in the company. And thank you for joining us. It's our topic for today is investing internationally for the global Filipino in Singapore and beyond. Next slide. Here's our agenda. Basically, we'll be giving some introductory information about investment, including dollar cost averaging, compound interest, goal setting, investment modes, jurisdiction, investment outlook, and what this means in the future for the investors. Next slide. Okay, so what is global Filipino? Because this webinar is targeted towards global Filipino. It's actually just an overseas Filipino, maybe full or partial Filipino origin, who are living or residing outside the country. And most of these, because of the exposure overseas, we are more savvy when it comes to investments. And they're more well-educated and well-traveled and more modern when it comes to their investment and the trends in the market. Next slide. Now we move on to dollar cost averaging, which is one of the investment topics, topics that we will be discussing. So DCA, or dollar cost averaging, it's a practice wherein an investor allocates a set amount of money at regular intervals. And usually it's shorter than a year, or could be monthly or quarterly. So generally it's used for more volatile investments such as stocks or mutual funds, for example. What it does is that it can include automatic deductions from your paycheck into a retirement plan. So it's a good strategy for investors with lower risk tolerance. So if you tend to be an investor with more conservative when it comes to your outlook in investment, this is actually a very good strategy for you to use. Next slide. Okay, so now we will give you an illustration of what it really means to do a dollar cost averaging strategy. For example, on the top side, the first scenario, the white boxes, is a lump sum investment of $800. So what that means is that the person has $800, or you have $800, and then you want to buy today. Some funds unit price is at $10. So when you buy it today, that's it. You're locked down at $10. So however, on dollar cost averaging, which is the green boxes at the bottom, instead of buying all in at $800, you spread it out into 8 different intervals every month. So divided by 8, that's $100 per month. And then, for example, today you buy the units at $10. But next month, because it's based on market, actually, it could go down to $7. So you get some discount here. Next month could be a bit higher at 15, but month after is 5 or 6 or 6.5 and 10. If you average all these prices, all these 8 buying points, then by right you will be getting more return by 20%. Next slide. But for dollar cost averaging, as markets fluctuate by investing on a monthly basis over a period of time, the average of the fund prices will show a better return. So say you have $1,000 per month, opposed to investing $12,000 in one lump sum. So as mentioned, if you average it, you will get a better return by investing monthly. Because the prices can go high or down, it depends on the market, on the global scene. Next slide. Here's another illustration of dollar cost averaging again. This time we make it a bit higher at 8,000 lump sum of investment. You buy it today, the unit price is $10. That's it. You're locked down at $10. So if next month, instead of the other one wherein you divide it by 8, that's 1,000 per month. Let's say you buy it at the same date and time every month. Then you can buy it at a lower pricing possible on the next months ahead, like $8, 8.5. And if you compare it for someone who put in 8,000 at $10 today to someone who did a dollar cost averaging in the span of 8 months, your return on monthly investment will be a bit higher at 4.07% instead of 0%. Next slide. Okay, now we move on to another investment idea or strategy, which is compound interest. Why should investors be concerned with compound interest? So compound interest, it demonstrates the growth of money over the long term. So our concept is similar to long-term investing. So if you consistently invest over the long term, your portfolio will begin to grow as both capital and past profits will grow. Another type of interest is, yes, next slide. Thanks. So another topic is what is the difference between a compound interest and simple interest? Simple interest is the basic one. Basically, it's calculated on the principal or the original amount of loan, and then you multiply the interest. However, compound interest is calculated on the capital, on the principal amount, plus the interest of previous period. And thus, it can be regarded as interest on interest. So that's why it's much better, it's much faster to have a compound interest, because including the interest from last month or previous months, basically it will be much bigger if you multiply the interest for this month's rate. Next slide. Here's an example. So just a sample case. So if you have, let's say, 5,000 today, and you have a rate of 5% return, you multiply it together, that will be 5,250. Okay, and then next month, let's say you put in another 5,000 at the same rate of return of 5%. Then you add the previous capital of 5,250, which we already have. So that's 5,250 plus 5 is 10,250. Then we multiply this with the 5% returns. So again, this is interest on interest. So the total return for 2 months would be 10,762.50 cents. Next slide. Here's an illustration of what it looks like in a graph form of compound interest. So if you see here, there are 2 colors, well, 3 colors in general, but the pink one would be the capital, the growth of the original. So that means this is a simple interest. Obviously, it will also grow higher. It will also grow, but at a much slower pace. And then you have the blue one, which is the compound interest. If you see here, obviously, it also account the interest from last month and previous months. So that's why it becomes much faster when it comes to investing. So that's why we always, when it comes to investing, a good strategy is to know what kind of interest the product is having, whether it's compound or just a simple interest. Next slide. Some investment goals. We are all different people from different backgrounds. So we have different goals in life and different needs. But one tip that we could share with you is to identify the time frame of your goals. So it depends on what goals you have. It can be short, it can be medium or long term, depending on the need. And also you have to know the specific. Is it supposed to be a retirement money for 65, or do you want to buy a new house or a second house? Is it supposed to be for an education of your children when they turn 18? Or is it going to be money for business? So for me, I feel it's very important that you categorize this thing instead of putting it in one account. It's okay, these are all my money, financial excess money or financial accounts. It's important that we divide them because they're all at different time frame. Next slide. Now we move on to what kind of investment modes or investment products you can actually choose from. So we're not going to name any specific products, but these are just ideas. One is investment account as in unit trust. So unit trust or funds, I'm sure you have heard sometimes of mutual funds. So it's almost the same. Your money is pooled with money from other investors, and then altogether they invest this portfolio of assets according to the fund's stated investment objective and investment approach. So the fund will be managed by a professional fund manager who decides what assets to buy or sell based on the investment objective of the fund. Next slide. Okay, another one is investment-linked funds, which is ILP. It's a little bit close to a unit trust because it's also invested, premiums are also invested in some funds with investment objectives. ILP value depends on the performance of the sub-funds, just like a unit trust. And just like a unit trust, ILPs do not have a guaranteed cash value. So it's very dependent on how the market works and whether your funds, the funds that you chose, are actually are actually doing well in the market compared to a participating funds, which I will also later discuss a little bit. So for participating policies, they have a guaranteed portion. However, the difference between a unit trust and an ILP is ILPs or investment-linked funds can have a life insurance component. So meaning for someone who wanted to have both life insurance, death, disability, critical illness, and and investment with money cash value from the funds, then this would be better than going to unit trust. But unit trust is better if you don't want any specific extra charges or you already have your insurance. Next slide. Lastly, we'll be adding in a whole life plan. A whole life plan is not exactly investment sounding. It's actually a life insurance plan, which usually is on a limited pay, like a 10-year pay. But it also comes with cash value. So under a whole life plan is under a participating plan, which means there's a portion that's guaranteed and then there's a non-guaranteed cash value. What happens is that the insurer will decide how the fund will be managed. So you will not get to choose which funds they will invest it in. So meaning if you decide to buy a whole life policy under, let's say, HSBC Life or Etica, then that company will be the one deciding where they're going to invest. But they will definitely give you the return in terms of guaranteed portion and non-guaranteed portion. However, it's also added here because any kind of insurance always acts as a wealth protection because of the death benefit. So that's why it's also partly under the investment modes because of the death benefit for the beneficiary. Next slide. Okay, now I turn you over to my colleague, Manager Reiner, who will be explaining about the jurisdiction.
We'll just take a little pause there and see if anyone else needs to join. I think we saw a message in the chat somebody would like to join. Maria did. If they'd like to try again now, we can let them in. So we'll just take a pause and see if anyone else would like to join before we hand over to Raina. Okay, I can't see anyone else wanting to join, so we will keep going then.
Okay. I'm not sure if anyone else joined, but just in case, we are LINC Wealth Advisers, a branch of Synergy Financial. Okay, so I'm going to pick up and talk a little bit about jurisdictions. When we're looking at where to invest as a global Filipino investor, you're going to probably have worked in different places, so you do have options, and it's good to know which options are better for you. And one of the things that we look at is access to global investments. So do you have access to the markets? Okay. Oh yeah, okay. So do you have access to the global markets and the products that you need to invest? So that would be through the banks and so forth, or are there government restrictions that limit what you can do? We also look at tax treatment. So there's the tax treatment of capital gains and tax treatment of interest income. These are two very important aspects of investing and choosing a jurisdiction. So that's something we need to consider. Also, the legal system. How robust is the legal system? Can you get a lawyer? If you go to court, are you going to get things done? And so forth. And then finally, the other point that I thought I'd bring up is currency. Of course, you want to be investing in a jurisdiction that has a strong currency that's not going to lose value over time. Okay, next slide. Okay, and as Hugo mentioned, Joanne and I are based in Singapore. We like Singapore very much because of some of the aspects of that we'll cover. For instance, the access to the global investment markets is very open here. There's no restrictions in that sense, so we can really get to all the products that we need. Also, another benefit is, of course, there's no tax on capital gains. There's no tax on interest income. And the legal system is, of course, renowned to be quite robust here. Not that you would need it usually when dealing with things, but in case something did, you could make yourself whole through the legal system. And of course, we know the currency is very strong. It's pegged to the US dollar, the euro, the great pound sterling, and so forth. That's a secret basically as to the formula, but essentially the currency is very stable. Next slide. Okay, so now switching from the mechanics of investing and so forth into more of an outlook for the rest of the year. So this would be basically some of the things that are what I've called here the bad news. So obviously we know the war in Ukraine is ongoing. That's causing a lot of uncertainty. We have the impact on oil and so forth and on trade. Certainly grain is a big topic, food. Our country's able to get enough food and so forth. China is also a big issue at the moment because the currency is depreciating. There's a real estate overhang in the market, so we've got lots of real estate that was built, but not enough people to live in them. We also have, properties that were highly leveraged, so there's a lot of leverage in the market, and people are either choosing not to pay those mortgages or they're not able to. So that's going to be a long-term factor when considering investment in China. And then of course we have the whole political thing with the trade war going on. So that's been an ongoing topic. It's certainly not going to go away anytime soon. Further far in the US, also the politics, and in particular the Trump indictments. There's a lot of risk involved in that. We don't know the outcome. It could just sort of all blow over and become history, or we could have some civil unrest. So I'm keeping an open mind about that. Another bad news, I would say, is the interest rates have risen substantially. That would be bad news if you have a loan, for example, or a mortgage. But on the other hand, it's for the first time in a long time, we're able to earn interest on bonds and bank accounts. So that is actually also a good point. It has two aspects to it. And then, of course, I'm sure everyone is familiar. We're all feeling it, the inflation that's happening around the globe. I think it's impacting pretty much every country. Prices are simply going up. Okay, next slide. So there's also good news. In particular, AI is a topic we've been hearing a lot about lately. So this has actually propelled the market quite a bit this year. There's a lot of companies that are in this space that have done well, and that sort of created a positive atmosphere for the stock market, I would say. And we've had a good, strong year, partly because of AI and tech as well. Digital currencies is a topic that is going to be with us for some time. It's not only about Bitcoin and so forth. We're also looking at fiat currencies eventually being replaced by, electronic currencies, and certainly that will play through. And there's a lot of opportunities for to make money in this, for good returns in this space. And another thing I wanted to point out is government's willingness to support companies, support individuals. I think this is a big one for me, because during the coronavirus pandemic, we saw how governments really stepped in, and they were ready to do just about anything they needed to do. They printed money, they paid people money. So and we also see people basically the willingness of governments to support whether it's private people or companies. That is a big factor, I think, in going forward. So that means that if we have some tough times, the governments will probably bail people out. They may not let a lot of companies fail, certainly if they're too big to fail. So that's always that's an aspect, I think, that we should consider. And finally, strong unemployment. We've had really, really strong employment. Which means that people have money in their pockets. They're able to pay their mortgages. They're able to pay their debts. They're able to pay for their goods and services. So that is obviously a good piece of news. Next slide. Okay, so what does all this mean for the global Filipino investor? And how do we translate all the good and the bad news? Well, the way I see it, essentially, it doesn't really matter. We're always going to have these kind of situations where you have, good and bad things going on. We've had so many events over the years, yet, ultimately the stock market does go up over time. And when we give our advice, we really try to avoid timing the market, because we simply cannot really predict the market, what's going to happen. And we really focus on the long-term goals. As Joanne was saying, we try to define what are the goals, and then work towards those over the long term to iron out all the short-term volatility that will happen on a daily basis or in the short term. So in general, we think that time in the market is more important than timing the market. And also, avoiding elephant hunting and lottery win style investing. This term comes from my time in investment banking and corporate banking. We were told to go out and elephant hunt, look for deals, try to bring in a big transaction to bring in lots of money for the firm. But we know, of course, those are few and far between. So when we want to invest over the long term, we just try to do that with a long-term strategy, as opposed to trying to win that one big transaction, which may never happen at all. So I think that's an important, some important point to mention. Okay, next slide. Okay, so when is the best time to invest? Really, the best time to invest is now, because you need time to in the market to grow your wealth. If you don't already have money, regular savings, as Jen was saying, is what's going to get you there in the end. And the good news is, if you're looking at something like a passive investing approach, which is what we do, the MSCI World Index, for example, has returned about 10% since 1970, which is really a strong, which is strong growth. And if you do this over the long term, you're going to reach the goals that you've set out for yourself. We also do active investing, so we have plenty of active funds where we would pursue a strategy of having something like a core portfolio with strategic investments or satellite investments. For example, healthcare, technology, ESG, among others. Okay, next slide. Okay, and I'm going to now pass on to Joanne, so she will pick up from here.
Thank you, Rainer. So lastly, we will be informing you what are the benefits of working with an advisor compared to investing on your own. First of all, when you're working with brokers or advisors, we are licensed professionals, so we are knowledgeable and updated in giving financial advice. We also are updated with the regulations in Singapore, especially, and also of the trends in the market, because we work with a lot of different fund managers and also with different insurance companies in general. Second is when you work with an advisor, we will help you develop your strategies suitable to your needs. So as I mentioned earlier, we all have different backgrounds. We all have different goals. So there's no one size fits all when it comes to products. Sometimes you can mix your products, two products in one. Sometimes you can just take one product. It depends on you. And it also depends on your timeline. Like maybe you want it in 10 years time. So because we know a lot of different products in the market, then it will be easier for you to develop strategies with us. Number 3 is we can provide a side-by-side comparison of the best plans from multiple companies. So basically, we work with a lot of different companies. So we don't have a specific bias over one specific company. So if you wanted, like, let's say, a unit trust or an ILP for that matter, then we can show you like the 3 different fund or 3 different ILPs that are suitable, again, with your number 2, suitable to your needs. So from there, you can mix and match. A lot of these products might be a little bit similar to each other, but if you look closely, actually, there's a little bit of tweak. Sometimes the other one is better in terms of a little bit of pricing. Sometimes there's a little bit of bonus that the other one will give. Then that's the time that you can actually mix and match, and you can choose which one is the best for you. Number 4 is also we can customize your plans based on your timeline, which is also partly number 2. As mentioned, like children's education, you need this money like when the child is 18 years old. So you have to time it well. If you come in a bit too late, let's say you want to invest when the child is already 13 years old, it's a little bit very hard to do that unless you do maybe a unit trust, which is more of a short-term goal. But in general, it will be better that you start early. You always start early so that you don't also get so pressured in putting in so much money and making it grow so fast. And then you don't have a lot of options anymore or plans because you started a bit too late. So it's best that you know what are your goals. And then from there, you can plan with us the timeline so that you don't get stressed out all of a sudden that you need to produce this amount of money at a certain year, so to speak. That's basically it for us. If you have any questions, yeah, you can contact me or you can contact Reiner as well. We have a website at linkwealthadvisers.com. My email is also there. So that's my name at synergy.com.sg. Yeah, and we will be having a replay of this video emailed to all the registered participants. Yeah, I think I will pass the baton back to Hugo for some questions.
So here's a question somebody sent in, which is, if I invest in Singapore, how can I get the money out again later if I return to the Philippines?
So if you decide to, let's say you have an investment in Singapore now that you're here, and by the way, it's not only people in Singapore or residents in Singapore that can invest money in Singapore. There is a term that we use, which are called passerbys. As long as they fly in or they are in the Singapore territory, they can buy plans. That's for endowment and ILPs and life insurance. But for unit trust, it's even allowed to sign over Zoom, so you don't have to fly to Singapore. So it depends whether you're a passerby or whether you don't want to fly, just want to buy unit trust. These are all doable, not only for Filipino residents of Singapore. Okay, well, when it comes to that, so let's say you already have bought all this investment or some products that you have bought with us, and let's say you're flying back to Singapore, flying back to the Philippines for good, or you're moving to another country, maybe you're moving to whatever, Canada, Australia, all these other Western countries, and it's still you can definitely continue to have it as long as you have the bank account, you're still paying for it. If you're already finish paying for it, it's also easy to claim, let's say, or to withdraw some money. Usually, there's just a form that you need to fill out. Then you will need to put in all the necessary documents, and also for also your bank account details, and it will be transferred to whatever bank you're in, whether in Philippines or in other countries' banks. Yeah.
That's great, thank you. Here's another question somebody sent in before about dollar cost averaging. So with dollar cost averaging, how much should I invest to get started and then each month?
For dollar cost averaging, it's usually, I would say the minimum would be at least 100. But of course, if you wanted to have the growth much faster, it will be better if you can put it at least at 500 per month, actually.
And those are US dollars?
Yeah, maybe just to add to that, yeah, we would be thinking in Sing dollar terms. But also, I think when we meet with clients, then we'll also do an assessment as to what is the affordability, how much can a person afford, and then be able to pay from their free cash flow to meet the goal. And usually it's, even if it's not enough to meet the goal, ultimately we can always review that in the future and increase the amount of investment. So I think getting started is the first part, and then maybe going up in terms of how much you save on a monthly basis is the second part, which can be reviewed later.
I have a lump sum that I'd like to invest for 3 years. What might I invest in?
I'll pick that up. So when we look at investing in the markets, we do tend to focus on longer term than three years. 3 years is relatively short. So if you were to put it into a basket of stocks or mutual funds, there would be a lot of risk that you would be carrying, because that would be, if there is sort of a correction in that 3-year period, you may suffer a loss once you want to get the money back. So if somebody were wanting to invest for 3 months, we want to keep that money invested into more liquid investments, money markets, short-term money market funds, something like that, which is not going to pay a lot of interest, but it at least will be relatively safe.
Are there charges if I want to switch or exit investments?
So the charges really depend on the product. We have, Joanne talked about the different kind of modes of investing. So if it's an ILP or a whole life policy or an investment account, usually there's not going to be any sort of exit fees to get out. Whereas if it's a whole life or a life insurance product, usually there will be a cost involved to exiting early. A sort of a surrender charge, and that usually we can map that out in advance to see how much is the charge. But it's really depends on the product.
Rainer and Joanne, thank you so much once again for the excellent presentation. And thank you to everyone who's joined us today. If you have any more questions, feel free to reach out to the panelists via linkwealthadvisers.com. and enjoy the rest of your weekends.
Thank you.